The Trump administration is floating around the idea of a 50-year mortgage plan potentially helping first-time home buyers.
50-year loans backed by the federal government.
The government's proposing a new mortgage plan, suggesting that to help Americans buy homes, lenders should begin offering 50-year mortgages, half a century tied to one loan. To many, it sounds like a lifeline, a longer timeline, a smaller payment, and finally, a chance for Gen Z to afford a home of their own. But the moment you run the numbers, even lightly, the idea collapses. A 50-year mortgage isn't a creative solution. It's a structural hazard. The kind that doesn't just strain buyers, but sends shockwaves through the entire market if anything goes wrong. Or worse, it's a government scheme to keep Gen Z poor and the billionaires rich. To understand why I'm saying this, we have to look at how we got to the standard that we have today. The modern 30-year mortgage didn't appear by accident. It was created in the 1940s, an era desperate to fuel home construction and stabilize a country returning from global conflict. By the end of the 1950s, it had become the backbone of American homeownership. The idea was simple: give families long enough to pay their loans comfortably while still building equity over time. It worked so well that more than 90% of buyers today choose the 30-year option. Yes, there are adjustable rate loans, interest-only products, and 15-year terms, but the 30-year mortgage struck the balance. Predictable payments, widespread availability, and a pathway to long-term home ownership. Still, buried inside every fixed-rate loan is a detail that many people overlook. The payment is split between two things: principal and interest. Three things if you consider escrow. At the beginning of the loan, though, interest takes the lion's share. The first payments go almost completely to interest, and only a very small fraction of your payment goes towards the principal. The ratio changes with each payment. The interest takes up less, and the principal takes up more. The early years barely chip away at the actual cost of the home. Only much later, after the loan amount has shrunk, do payments actually build real equity. Most homeowners never get to that stage, though. The average person moves after about 12 years, which means most people sell their home just as their loan is finally starting to work in their favor. And if someone stays the full 30 years and pays off the house, the total cost of that mortgage is staggering. A home purchase for, say, $600,000 can cost closer to $1.2 million by the time the loan is paid off. That contrast explains why some buyers consider the shorter 15-year terms. The interest savings are enormous, but the trade-off is steep. A 15-year loan demands far higher monthly payments and far higher income to qualify. For most households, the shorter term simply isn't accessible. The 30-year loan, for better or worse, is the middle ground people could actually afford. This is where the argument for a 50-year mortgage appears. The belief that if you stretch the term even further, you'll dramatically lower monthly payments. But that assumption falls apart the moment you start doing any math. You see, a jump from 15 to 30 years increases affordability by roughly 34%, and that's substantial. But going from a 30-year to a 50-year mortgage barely even moves the needle. It will give you less than 8% improvement. Nearly doubling the length of the loan barely changes the monthly payment at all. In the absolute best-case scenarios, you may only save a couple $100s a month. And while a couple $100s helps a lot, when you're making a monthly payment of $3,000, it doesn't help that much. It certainly doesn't justify an additional 20 years of mortgage payments. And that's before considering something crucial. Longer loans almost always come with higher interest rates. Lenders expect compensation for locking up their money for longer periods. Today, the average 30-year mortgage rate sits around 6.1%. A 15-year loan is significantly lower, closer to 5%. So, a hypothetical 50-year product would probably almost certainly push interest rates higher than the 30-year, probably closer to 7%. So, run those numbers on a $500,000 loan. At 6% over 30 years, the payment lands around $3,000. Stretch that to 50 years, At 7%, and the payment doesn't fall. It actually rises. Even if you imagined an unrealistic world where a 50-year mortgage carried the exact same interest rate as a 30-year, the payment drops only about 10%. That's the entire benefit, 10%, in exchange for 20 extra years of debt. There's also a second problem, one that barely shows up in public conversations, but matters deeply to the stability of the financial system. The 30-year mortgage works because most people don't keep it for 30 years. On average, loans are paid off or refinanced after about a decade. Because of that, investors and private equity treat them as a rough equivalent to a 10-year government bond. They're predictable. They turn over. They create liquidity. That's why mortgage rates track so closely with the 10-year U.S. Treasury yield. A 50-year mortgage breaks that entire structure. If a buyer takes out a 50-year loan, makes payments for a decade, and then sells their home, almost none of the principal has been paid. On a typical purchase, say $550,000 home with 10% down, the borrower may have paid off only $32,000 of the principal after 12 years. If the market stalls or dips even slightly, that homeowner walks away with less money than they put in as a down payment, leaving them even more broke than they were before they bought the house. Not because they did something reckless, but because the math of the loan works against them. To that point, you would be better off renting and not worrying about having to fix a roof or pay for a new HVAC system. For lenders holding these loans, the risk is even clearer. If interest rates fall, the borrowers will refinance and the lenders lose the benefit of the long-term loan they issued. But if interest rates rise, lenders are stuck for decades with a below-market return, losing out on profits from loaning that money to somebody at a higher interest rate. A 50-year mortgage locks both parties into a fragile arrangement where almost every scenario creates losses. All this is why qualified mortgages, the safer, regulated loans that form most of the U.S. market, are legally limited to a maximum 30-year term. Anything longer becomes a non-qualified mortgage, which means higher risk, more liability, and higher interest rates charged to the borrower. There's simply no path where a 50-year mortgage can be offered at the same rate, with the same protections, without creating structural hazards for everyone involved. So what would a 50-year mortgage actually look like in practice? Well, most likely, it would appear only in small pockets, created by developers who quietly raise home prices to offset their financial disadvantage from the loan terms. It might even require the issuing of loans that pass from parent to child, simply because the original borrower wouldn't live long enough to finish paying off the loan. All of this underscores the larger point. The 50-year mortgage doesn't solve affordability. There are meaningful ways to increase housing availability without destabilizing the system. Adjusting the capital gains exclusion for sellers to reflect modern home prices, allowing homeowners to transfer an existing mortgage rate to a new primary home when they move, restoring a more generous mortgage interest deduction for future purchases. These steps actually unlock inventory, and housing inventory is what the problem is, not the length of the loan. A 50-year mortgage, at its core, is a distraction, a headline that sounds bold but collapses under the weight of basic math. It doesn't make homes more affordable. It doesn't strengthen the market. And for the average buyer, especially one already in their 40s, it pushes the finish line so far away that it barely even resembles homeownership at all. A half-century mortgage may sound like a modern solution, but it asks buyers to carry the weight of 2 generations worth of debt for the smallest possible return. The 30-year mortgage became standard because it struck a delicate balance, stability for lenders, predictability for investors, and a real chance at equity for homeowners. Stretch that balance out to 50 years and the foundation just disappears. When the math works against both sides of the loan, the structure simply cannot stand. The answer to housing affordability isn't time, it's supply. And until that changes, extending the clock won't change the outcome. Thank you for watching. I hope you enjoyed the video. If you did, please subscribe and leave a like. If you didn't, subscribe and leave me a comment.